So the question I like to ask myself is, where would the price of silver be if the banks were only allowed to run a short position that was 110% of the dollar value of the silver backing the contracts?
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics, and nice to have my old friend Dave Kranzler joining us back on the show. I know we haven't done these as often as last year, which I'll figure out a better solution to that, but always great to catch up with you, Dave, and see what you are noticing in the gold and silver markets, where I believe our last call we had seen the beginnings of a gold and silver rally that really from mid-February to mid-April was quite stunning. And as we'll dig into in a little bit, we've seen this in the face of the increased short positions, which typically bring the price back down in check. Although I haven't really had a major sell-off, I wouldn't say so far. I mean, we have had sell-offs along the way. And Dave, as we open up here, we're recording Monday afternoon on the East Coast. Silver just under $30, gold settling in about 23.41. And with all that said, it's a pleasure to see you as always. And I'm sure you have lots to say about what's been going on. But first of all, before we start, how are you, my friend?
I'm doing well. How are you doing?
I'm doing great, great. And looking forward to seeing your thoughts on this because I think the main thing that stands out to me, especially on the silver side, is that you've seen the short position continue to grow, unwind a little bit in the last 2 weeks, versus on the gold side, we have seen the open interest come back in quite a bit. So, anyway, a lot that's happening, and perhaps with all that said, you can take it from there and share what you're thinking about the current point we're at.
Well, we did have a pretty big smash on Friday, and that's typically what happens on a Friday, right? And if you look at a time-stamped chart, that sell off the waterfall decline that we saw in gold and silver, it didn't start until the Comex opened. So, and that's significant because by the time the Comex opens on a Friday, the only two markets open in the world are basically, obviously Mexico, North America, South American markets, but the only two markets where gold is actively traded, and I want to qualify that by saying in New York, it's obviously just gold derivatives, is New York and London. And then once London closes down, once they do the PM fix in London at 10 a.m. New York time, then it just leaves, the children in the sandbox playing in New York. And that's basically what we saw on Friday. Now, I'm not saying that was all the banks just smashing bids. What they do is the hedge funds that chase the price up and down have sell stops in there, and the banks, because they own and control the Comex, they run the systems. They basically know where the stop losses are, so they target those. And so it's a combination of the banks getting the sell off started, and then the hedge fund algos kick in with their sell stops, and that's why you see these. Jim Sinclair called them fishing lines, fishing line formations. So, and that's what we saw Friday. I mean, what it tells us. I mean, I'm included in this, and I'm sure you are too. There's a whole school of thought out there now that the West is losing its price setting ability in the precious metals to the Eastern Hemisphere. And I think for the most part, that's probably correct. I mean, you look at those daily updates from that guy in China for dollar equivalent pricing on the Shanghai Futures Exchange and the Shanghai Gold Exchange, and the prices where gold and silver are transacting over there. And those are, well, not the SFE, but the SG, the Shanghai Gold Exchange is a physical gold trading market. That's what they do. They trade physical gold. And so, the prices where gold and silver are being transacted over there are significantly higher than where they're occurring on the Comex. So, but what happened on Friday it basically tells you that the West still has some ability to um, do what they can to control the rate of ascent of the prices of gold and silver.
Although, Dave, as we take a look at the swap dealer position, which is in this green line here, we can see at 37,000 contracts short has blown out during this rally. Here we are in mid-February, and what were we at? 1,700 contracts long. So we've seen the price in that time go from 23 over 32.50 at one point. Now it's perhaps somewhat unsurprisingly been pretty volatile around the $30 mark, yet still $6 higher now with the short position continuing to grow. We've seen perhaps some signs of some small amount of short covering. Again, here's about 1,200 contracts last week and similar amount the week before. But are you surprised that we haven't seen a bigger sell-off, or what do you make of what is happening here on the bank side of the silver market?
Well, this is an interesting exercise. So the open interest that's outstanding, and you can calculate it out just for July silver. The open interest that's outstanding far exceeds the representative underlying amount of physical silver that's available for delivery in the COMEX. So the question I like to ask myself is, where would the price of silver be if the banks were only allowed to run a short position that was 110% of the dollar value of the silver backing the contracts, supposedly? Because that's how it is in almost every other commodity, is right, especially like with agriculture and livestock, because that those are delivery markets. The COMEX is not a delivery market. And I don't care what people say about deliveries. They're deliveries until the gold and silver gets removed from the COMEX by the people who are taking delivery. So they can say they can issue warrants on bars that have multiple warrants issued on them if they want to. So and not enough people stand for delivery for that even to need to be the case. But if the banks were required to hold their net short position to just 110% or 120, and then you would do that so that banks have the ability to make liquidity, make liquid markets. The prices of gold and silver would be significantly higher. So um, I I think the banks are going to keep playing their game on the COMEX until they get burned. And I don't know when that's going to happen. When they get burned, it's when all of a sudden enough people stand for delivery and there's not enough metal on the exchange to deliver into those who are standing. Because until that happens, they can just keep doing this wash, rinse, repeat process where they get short, they keep shorting into the price as it moves higher. And then you see something like Friday where they book a lot of profits. So, um, I think we're just going to keep seeing that. I do think that the fact that gold has hit multiple record highs over the last since March, over the last 3 months, and silver, I mean it hasn't, technically it hasn't had a true breakout, but I think we were all kind of looking at that line in the sand that had been drawn kind of between 28 and 30, and it broke out of that, and now it's back down there, bouncing around. And I don't know, because typically June and July are seasonally slow periods for the precious metals, and so a lot of times you'll see the prices drift lower. But I would say that once the Indian gold buying season kicks in, and the wholesalers start buying in August, and I think the public really, I think the buying really kind of kicks in late September and October. I think we'll see silver break out above 30 again and hold and start to move toward 40. Now, I'm not going to say that we're going to see 40 by the end of the year. We could. But I think generally, I think we're going to start to see or keep seeing the prices of gold and silver move higher for at least the rest of this year.
Okay, and that actually leads into the next question I wanted to run by you, because I know you mentioned the when of these matters is obviously a difficult thing to know. So we'll leave that aside. But Perhaps you could talk a little bit more about the what. I don't know that you and I have ever talked about this specific part before, but all right. Silver Institute is reporting roughly 200 million ounce deficits for a couple of years, suggesting that going forward. We have seen inventories come down. It's interesting. The Comex and the LBMA, the brunt of those declines was really more of a 2022 thing. And Comex is a little bit higher now with registered at a little bit above 60 million ounces, whereas the LBMA has flattened in the last year or so. As I showed you before we started our call, we can see that the decline in China, where obviously you have a lot of the strong industrial demand, has continued. So under 100 million ounces here between Shanghai Gold Exchange and Shanghai Futures Exchange. Obviously, you know about the conditions facing the mining companies as well. Do you think that this gets to a shortage eventually? And I try to be careful how I phrase it, where I think we have a deficit, which I would not call that a shortage at this particular time. But do we get to a shortage? Is there some sort of event, or in terms of a longer term perspective, we could also touch on it. I'd love to know, do you see this current situation ultimately needing to be resolved with some sort of gold and silver reset? So why don't we start there with first on the silver side, and then maybe we'll see the gold and silver as well after that.
I I have no reason to doubt the Silver Institute's numbers. I mean, they're I would be shocked if they were 100% accurate, but leaving room for error either way, I would say their numbers are probably pretty good. I would also suggest that part of the reason, well, part of the reason that we've seen gold and silver move higher like this is the Eastern Hemisphere is pushing the price higher with their demand, enormous demand, and not just China and India. So I I have to believe that, because no one knows for sure what goes on between GLD and SLV, right? In terms of the metal that actually moves in and out, what the quantities are, and they're set up so to make it impossible for outsiders to read into that and see what's really going on. I would bet that part of what's bridging the supply demand gap is silver that gets taken out of SLV and used to make deliveries. And can I prove it? No, but you can't prove that it's not. And you saw that decline in the physical silver on the SFE and the SGE. And that could also, those are withdrawals. And so that silver could also, that may be being used to bridge supply deficits. I don't know. I mean, I concluded early on when I started in this sector 23 years ago that everything that goes on in the physical gold and silver market is intentionally opaque, because whether anyone wants to admit it or not, gold is still regarded as the ultimate form of money, right? Even Mr. Money Printer Alan Greenspan wrote a brilliant essay about that, which I'm sure everyone in the audience has read. And if you haven't, look it up and read it. Gold and Economic Freedom, written in 1966.
I know it's one of your favorites.
Yeah. And it was funny because whenever he would have to do his semi-annual, they used to call it the Humphrey Hawkins testimony. Now I don't even know what they call it anymore. Who cares? It's a waste of time. But it was worth watching it back then in the 90s, because Ron Paul would start grilling him about gold. And Greenspan would, he'd talk in his circular, the guy was just a brilliant wordsmith and phraseologist, but he could say a lot of words and make it sound intelligent, but he'd not really say anything. But every once in a while, he'd drop a little tidbit in there to let at least Ron Paul and those like us in the audience know that he still believes gold is real money, is the ultimate form of money. So but I digress. So I think I just think that what's going to have to happen is that the official above ground stocks in the structures like SLV and in the Comex are probably going to have to be drained before completely drained or close to completely drained before. And when I say drained, not the report that you read every day about what the warehouse stocks are. People actually removing the metal and moving it out of the Comex vault system. I think we're probably not going to see a price reset until something like that happens.
We've seen that a bit more recently on the gold side. Here is the Comex registered gold. Obviously was a lot lower before you had the EFP crisis in March of 2020, but we can see that has come down quite a bit below 8 million ounces. I don't know that I would call that a run on the gold yet, but do you think it will get to that point, Dave? Especially now that we continue to hear more detail, whether it's verified fact or not, but at least some more detail about what the BRICS may conceivably be doing with their unit currency. Payment mechanism, I've tried to be precise with the terms. I guess debatable whether you would call that a currency.
Go back to that chart for a second.
Of the COMEX registered?
Yeah. I mean, how do we know that gold, that when you see it spike up, how do we know that spike up to 20 million ounces? How do we know that gold was actually physically in the Comex vaults? Because remember, they introduced that ACE contract that let the Comex pretend that it could use the gold in the LBMA vaults for delivery. Remember that?
Mm-hmm.
And so I don't know that that's necessarily all that gold was sitting in the Comex. Now, some of it could have been, but not all of it. It was accounted as if it was because of those ACE contracts. So, I mean, look at the level that the registered stock level from 2014 to mid 2019. I mean, it got down to under 2 million ounces, and the price basically, well, until 2016, the price went sideways. And then at starting in August 2016, started going lower for a while. So I don't know if we can read that much into what these charts are telling us, because they're based on the reports that are issued by the Comex. And who makes the reports on the Comex? The banks make the reports, right? And if those reports are honestly compiled, it'd be the only financial reports issued by banks that are honest. I mean, we can go through a bank 10K and I can show you where there's accounting games being played, everywhere. So I don't know what to read into that. It could be reflecting increased demand in physical gold, but we already know there's an increase in demand in physical gold just from central bank buying and import numbers into China and India, right?
Yeah. So, although back to the key question, do you think this is headed towards at some point having a failure to deliver?
I think eventually, yeah. I think we almost had that in 2020. I think it came close to that. And then because I think there were people who saw what was going on, who had warehouse warrants, and they were going to start taking their gold out, but they smoothed everything over with those ACE contracts. I don't know if you remember the circumstances when that thing was put. I mean, it was hastily put together, in the spring of 2020.
Yeah, it's hard to imagine that it's already been 4 years ago since all that
Incredible.
thing, and 3 years since the silver squeeze. And I think in due time we'll probably look back at 2024 as, I think it's already been in some ways one of the more historic years in metals, especially when you look at silver. If you leave aside the couple of hours that we had silver over $30 in 2021, during that Monday following the silver squeeze weekend. It's only the third time in history that silver's been above $30.
Yeah.
Last two times it went above, it did get to that $49.50 level, which does not guarantee that we will see that. Although, especially Dave, how many times over the past couple of years did we discuss how silver kept getting up to that $30 level, hadn't broken through? And curious, your thoughts. This is something I've asked a lot of the guests, just in terms of the trading we've seen once it broke through 30, which the day it did that, it almost hit 32. We've seen it pretty darn volatile, which I think in one hand makes sense and could have been expected. But anything that you've taken away from how silver's hovered pretty close to that $30 mark for the better part of a month or so at this point?
Like I said, I think right now, I think what the banks are trying to do is keep silver from permanently breaking out over 30. Because, and I don't agonize over the technicals, but apparently there's some guys out there who are saying, if silver gets into the mid 30s, the hedge fund buying will really kick in. And that's what we saw in 2011. So I'm impressed how silver is holding kind of the 29 level, right? They've bashed it down below 29 a couple times I guess in the last 3 or 4 weeks, and it bounces back really quickly. And same thing with gold when they try to get it below 2,300. I mean, it's got resilience, at least for now, at those levels. Now, I can't guarantee what's going to happen, especially in July, because that's when everything really slows down, and it becomes easier to manage the price of gold and silver, because people aren't around, they're taking longer vacation, the whole thing. So um, that's why I think, especially once India kicks into gear late summer, early fall, that's why I really think that we're going to see gold get over 2,400 and silver get over 30 and hold those levels and move higher from there.
Well, that makes sense. And for a while we had that, then came back below. So we will certainly keep an eye on that. And Dave, the last thing I wanted to run by you, obviously we've had the higher rates, had some amount of quantitative tightening, yet here you see the longer term chart of the NASDAQ and thing continues to soar. Let's puts it in perspective. And I'll pull up here's S&P and also the Dow Jones. Anything you would say to people that were expecting more of the chaos, perhaps, with the higher rates? Saw that for a little bit about a year ago. Obviously, we did have the situation with the banks, so which was resolved with the BTFP program. So I know some people say, well, we've had rates higher for longer and nothing broke. Well, that's not really entirely true. I mean, it broke, they patched it up. And I also have the monetary base, which I know you're going to want to highlight or I'm highly confident you'll want to highlight it in your response. But anything you can say to that, just to people who are seeing the stock market levels and wondering what to expect there?
Well, I think that the draining of the reverse repo facility has essentially acted like QE on the stock markets. I'm not saying it's acted like QE per se on the Fed balance sheet, but certainly on the stock markets. And the one you got to ask yourself, that's the monetary base, right? Which is bank reserves plus coin and currency in circulation. Why? And if you ran, yeah, okay. So if you ran that back to March 2023, you'd see that it's actually been rising since then. And then it kind of came down a bit, and then it's been rising since July. So you have to ask yourself, and the Fred site segregates. You can get charts that segregate coin and currency in circulation and bank reserves, and most of that increase in the monetary base is bank reserves. So you have to ask yourself, why is the Fed kind of on a low grade basis pumping bank reserves into the banking system? So that tells me that more than likely, well, I think they're doing it partially to help support the stock market, but also I think there's a real problem in the banking system, and the Fed knows it. I mean, I think this last FOMC policy statement was the third consecutive or the fourth consecutive policy statement where they removed the sentence, the banking system is sound. You know, not that that's a paraphrase of what they said, but all of a sudden, 3 or 4 meetings ago, that statement disappeared. And not that many people noticed it. Certainly, they didn't notice it on Bubble Vision, CNBC, et cetera. So, there's clearly something percolating in the banking system. And I think the Fed has to keep rates up where they are for now. It's kind of like kabuki theater, right? Because if they start to lower rates, I mean, the dollars probably falls off a cliff. And they also know, I mean, that's keeping rates high is their cover story for fighting inflation. But they're not fighting inflation if they're pumping reserves into the banking system because it's increasing the money supply. I mean, we looked at that M2 chart over the last year before we started recording, and M2 has risen since July also. So, and if they want to really attack inflation, they got to pull liquidity out of the system. That chart's just do a 1 year because that chart's the scale is deceptive. See, so and that's not a big increase in M2, but it's an increase. And if they're really honest, if they're serious about fighting inflation, why are they letting the money? Why are they letting the money supply increase slowly? Why are they pumping bank reserves into the system? So um, I think keeping interest rates where they are for now is really just kind of putting lipstick on the pig. And they certainly know that inflation is much worse than the CPI is telling us it is. And
Well,
that again, I think that's part of the reason why gold and silver are moving higher because gold and silver buyers they see those numbers. They know something's really messed up in our system.
well, I know you'll be sitting there eagerly awaiting. You get PCE on Friday, Dave. So another one of your favorite government set of data for what's going on the inflation front. Although, fortunately, I guess for everyone at home and can get insight into any of these things in the Short Sellers Journal, which just hit my inbox late Sunday night, as well as the Mining Stock Journal, which is Dave's research at investmentresearchdynamics.com. And Dave, before we wrap up, any quick thoughts? We did have some interesting drill results from Fortuna Mining. I think many people have seen also that Fortuna Silver is now, we've done a rebrand, and Fortuna Mining. And Thursday afternoon, they also had some drill results that we were looking at here. And anything that you would like to share about that?
I mean, we were on the podcast with Jorge, and we were when we talked about uh, that financing that they did, right? And then we started talking about Segela, and he was visibly excited about Kingfisher. And he can't come out and say what he thinks is really there, but I mean, Kingfisher looks like it could be a monster deposit. And I mean, it just highlights, and then look at the Badior prospect. Look at those drill results, and those are near surface. I mean, they're just below the surface. So that's if there's a deposit there that's that shallow, it's cheap to process. So I I think there's going to be a lot more discoveries on Segela. I mean, they just happened onto the Kingfisher discovery, and it's already produced monster assays, and it sounds like they want to aggressively drill it. So I personally believe that Segela alone is worth Fortuna's market cap. So and a couple issues ago, you saw the comparable valuation numbers with comparable gold silver producers that I laid out in there, and I mean Fortuna's probably at least 50% undervalued relative to the comparables. So If you take the view that Séguéla is worth the $1.5 billion market cap, then you're getting the rest for free. Lindero, Hyoma, um, Yaramoko, and then it looks like, and we won't know for sure because they got to do more drilling, but it looks like they're going to be able to extend San Jose's life of mine with that Yessi vein discovery. So, that's not set yet, but the market's not giving them any credit. The market's treating them as if they're shutting down San Jose. So there's optionality upside there. And then with Diamba Sud, right? There's optionality upside there. And Jorge was also on that same podcast. Jorge was visibly excited about Diamba Sud. I mean, and he came out and said he thinks it has potential to host a world-class deposit. So, and the drill results from there have been phenomenal so far.
Yeah,
That's kind of a long-winded way of saying, I mean, these are just phenomenal drill results, and it just, continues to highlight how much gold is yet to be found on Séguéla.
yeah, and I was just going to say it certainly has been quite a year. And Dave, do you realize this is another week or so, and it'll be just about a year ago when we were actually there visiting Sequoia in
You know
person.
what? Believe it or not, I was just thinking about that this morning.
Yeah. So it was impressive to see what they've done and certainly what they've done since then. And also, again, impressive to see all that you've done and certainly writing and speaking about a lot of the things that I think we're seeing happen now. It's no longer where we're back in 2001 or 2004 and saying one day there might be some of these issues coming. But in either case, I appreciate you being a good teacher for me on my journey, as well as many people watching and listening in the audience. And again, you can find Dave at investmentresearchdynamics.com. And Dave, pleasure to see you as always. We will do this again soon, and you take care of your good self. And thanks for joining me.
Thanks for having me on, Chris. I love doing this show.